Well, good morning, Jagendra Rana here. The topic of the day is marine cargo transit insurance. Marine cargo transit insurance. So, marine insurance is the oldest branch of general insurance. Marine insurance covers loss or damage during the transfer of property from origin, origin to destination, including ships, goods, terminals, and various transportation modes. So, cargo insurance is subset of marine insurance, which also encompasses onshore and offshore exposed property like containers, terminals, ports, oil platforms, and pipelines, hull, marine casualty, and marine liability. So, the cover or the coverage spans from carrier's departure to its arrival. Apart from sea, marine insurance covers loss or damage through rail, road, and air as well. So, marine insurance is often thought of as coverage for shipping goods by sea. However, it offers more than that. Marine insurance policies also protect goods during transportation by rail, road, and air. So, marine cargo insurance provides coverage for goods transported through various modes, including sea transport, protection for items shipped by sea vessels, air transport, coverage for cargo transported by aircraft, land transport, insurance for goods moved by truck, trains, and other road and rail vehicles, inland waterways, coverage for items transported via rivers, canals, and other inland water routes. So, there are some special features of marine cargo insurance. Insurance companies offer policies designed to meet the specific needs and requirements of customers involved in transporting goods via sea or waterways. So, customers can decide on the insured value of their goods, which can be either the actual value or an agreed upon value. Insurance providers may offer flexible premiums payments options such as annual, quarterly, or single payment plans. These options vary from plan to plan. So, the actual features are typical one because different types of marine cargo policies are available tailored to specific requirements, but the specifics can differ from one insurance company to other company. So, cargo insurance or the transit insurance provides coverage for the transportation of goods from origin to destination. There are three types of plans under cargo insurance that you can purchase as per your requirement for the number of transits and kinds of coverage you want in your policy. They are the open policy, specific policy, and annual sales turnover policy. So, the open policy is a type of marine insurance policy that offers continuous and comprehensive protection for the cargo during multiple shipments throughout the year. It is a convenient and cost effective choice for business engaged in regular shipping, as it covers goods on various trips within the specified 1 year period, unlike single transit insurance which only applies to a single journey. But single transit insurance and marine insurance is a type of coverage that protects goods or cargo during a specific single transit or voyage. It is designed to cover the cargo while it is being transported from one location to another location. So, the destination via a vessel such as truck, train, ship or plane. And then the annual sales turnover policy offers insurance coverage for the projected annual sales turnover of a company engaged in marine transportation. So, this policy safeguards the company's financial interest by protecting against potential losses or damages during its operations. For example, if financial year 2023, in financial year 2023, if a company plans to export goods worth rupees 100 crore and import goods worth rupees 50 crore, they can opt for a stop policy, that is sales turnover policy. So, the insurance company will calculate the premium based on rupees 100 crore estimated sales. However, the coverage provided to the insured will be for both the rupees 100 crore export and rupees 50 crore import, totaling rupees 150 crore for potential loss or damage. In marine, there is a separate branch that is called hull insurance. It provides extensive coverage for damages to the hull machinery and equipment of a vessel. It protects ship owners from financial losses due to risks like collision, grounding, fires and storm, ensuring the safety of their maritime assets. So, marine insurance is the oldest form of insurance. This is important part of commerce and trade, both domestic and international. It is connected or concerned with the inland transit and exports and imports. So, mode of transit may be by rail, road, inland, waterway, sea, air, registered post or even courier. As far as domestic trade is concerned, sales and distribution of goods within the country is there. But in international trade, export and imports of goods to or from other countries are there. So, the parties to the contract are sellers or exporters, buyers or importers and intermediaries. Customs clearance for export means shipping bill or bill of export is the main document required by the customs authority for allowing shipment. So, the following are the documents required for the purchasing of the shipping bills, like GR forms in duplicate for shipment to all the countries, 4 copies of the packing list mentioning the contents, quantity, gross and net weight of each packages, invoices which contains all relevant particulars like number of packages, quantity, unit rate, total FOB, CIF value, correct and full description of goods, then contract, letter of credit, purchase order of the overseas buyer, AR, both original and duplicate, and invoice, inspection, that is examination certificates, and bill of exports for the goods which are cleared by land customs with all the above documents. Documents required for export are again very important, and these documents are, say for example, letter of credit. This is applied for making payments for imported items once the required papers are handed over. A letter of credit mainly says that the importer's bank guarantees to pay provided the entire documents specified in it are on order. Purchase order means it appears like a trade requirement, but it may be desirable for financing. So, the buyer may need to prove that the order to his bank to organize a provisional loan, or customs may desire to see the paperwork to make sure the whole thing is legitimate. Then certificate of origin, where various countries have limitations on the introduction of commodities from certain other countries and may apply duty to these commodities or ban them altogether. on the other hand, there may be tax benefits on the items from specific supply sources. In such cases, an exporter will require to present a certificate of origin which is certified by a designated regulatory authority. Bill of lading means this is a document required shipment documents for sea consignments when commodities are sent by sea route as proof that the commodities have been sent by the supplier. Airway bill, same as bill of lading except that it is a document involved in air shipment. Inspection or quality accident quality credentials, if the buyer requires an examination of goods prior to shipment. These are vital documents to making sure the deal is established in accordance to the buyer's requirement. Then the list of all of the cardboard boxes within the container and the contents within the boxes are provided in the packing list. Invoice is the most essential document to make sure that a complete synopsis of merchandise is outlined and it is invoiced in the currency of sale. There are other detailed requirements from country to country. For instance, Australia has a strict quarantine limitation governing the trade of animal and food items. You will need to secure a permit or subject your items to an inspection or both. Then documents required for imports. This includes bill of entry, that is import declaration, signed invoice, packing list, bills of lading or bills of lading airway bill. Completion of the GATT has been filled in the declaration. GATT means General Agreement on Tariff and Trade. Then importer or his customs declaration agent approval when necessary, letter of credit, bank draft when necessary, insurance documents, import license, trade license when necessary. Then documents required for imports are different because they include laboratory, that is Department of Chemicals to provide the goods, permitted to make tax free, the right tariff exemption certificate, right of tax refund certificate, original. Then catalog, detailed technical specifications, related documents. The goods are machinery and equipment to provide spare parts of or chemicals. A single price of machinery and equipment spare parts, certificate of origin, that is application of preferential tariff rates to provide, and no commission statement and pre-declaration customs declaration and green channel changes. So for the trade, intermediaries are there, that is commission agent, they sell goods on behalf of the principal, and clearing and forwarding agent, custom examination and clearance, arranging conveyance, laws, cargo claims, warehouse keepers for required for storage, shipping agents, shipping documents, arrange insurance, customs clearance, towing or space in ship. Then stevedores, contractors appointed by shipping companies for loading and unloading of cargo, stowing the cargo inside the ship. Banks provide loan, facilitate trade by issuing letter of credit and exchange of trade documents. Then carriers, etc., various carriers involved in the journey. So for trade, the provisions of Sale of Goods Act 1924 are applicable, where the consensus ad item in regard to the terms of sale between seller and buyer in the country or when they are in different country. Seller and buyer both have obligations to fulfill the terms and conditions of the sale agreement. For better understanding the terms of trade, International Chambers of Commerce and brochure attach such definite meaning to various sale terms used internationally. Insurable interest is important because the provisions of Marine Insurance Act 1963 will be applicable here. Every person has an insurable interest who is interested in marine adventure legal and equitable relation to the adventure or to any insurable property and risk therein, in consequence of which he is benefited by its safe arrival or prejudiced by its loss or damage or incur liability as a result of such loss, damage or detention. So, insurable interest must be there at the time of loss or damage. The goods may change may hands during transit. At inception, the insured should have reasonable expectation of acquiring such interest. The loss to subject goods may be recovered even if the loss took place even before the insurance was concluded, provided the insured is not aware of it. So, lost or not lost makes the cover retrospective provided good faith has been observed. Underwriters take precautions by denying cover if the transit has commenced before insurance arrangements. Section 64 VB confirmation is required. So, if insured has no interest at the time of loss, he cannot acquire it later after he is aware of the loss. Before or after the loss, assignment could be there, but the marine insurance policy or certificate is freely assignable when interest passes due to trade requirement or unless prohibited in the policy, like seller interest clause, duty insurance, STP, annual policies, increased value, special storage risk insurance. So, the insurance has the same defense against the assignee as he had against the assigner. Measure of insurable value means an insurance on ship. The insurable value is the value at the commencement of the risk of the ship, including her outfit, provisions and stores for the officers and crew, money advanced for seamen's wages and other disbursement, if any. So, incurred to make the ship fit for the voyage or adventure contemplated by the policy, plus the charges of insurance upon the whole. In insurance on freight, whether paid or advance or otherwise, the insurable value is the gross amount of the freight at the risk of the issued plus the charges of insurance. So, in insurance on goods or merchandise, the insurable value is the prime cost of the property insured plus the expenses of and incidental to shipping and the charges of insurance upon the whole. As far as indemnity is concerned, a contract of indemnity or contract of marine insurance is a contract whereby the insurer undertakes to indemnify the insured in the manner and to the extent agreed in the contract. In other words, it is not a contract of indemnity ideally, but for an indemnity according to the conventional terms of the bargain. It is a valued policy on the basis of the value of the assignment is prior agreed. On the basis of the value is calculated as per the Marine Insurance Act. So, a valued policy is a policy which specifies the agreed value of the subject matter insured, subject to the provisions of the Marine Insurance Act, and in the absence of fraud, the value fixed by the policy is as between the insurer and assured, conclusive of the insurable value of the subject intended to be insured, whether the loss be total or partial. So, the insured is obliged to disclose to the insurer every material circumstances. A circumstances or effect is material if it would affect either the premium or the decision to accept the risk. So, the disclosure must be made before the contract is concluded, and failure to properly disclose material facts entitles the insurer to avoid the contract. So, the contract is not automatically terminated. The insurer must elect to avoid it and must return the premium. So, there are terminology which is frequently used in marine insurance, that is FOB means free on board, C&F means cost and freight, CIF means cost, insurance and freight, X works means from the premises, FCA is free to carrier, FAS means free alongside of ship, CPT carriage paid to freight, CIP carriage and insurance paid, DAF delivery at front at border of nations, DS is delivery ex ship, DQ is delivery ex QA, DDU is delivery duty unpaid final port, and DDP is delivery duty paid at final port. Thank you very much.